Stock market outlook. Is the bull run sustainable? Hello everyone, welcome back to the channel. Today, we're diving deep into a comprehensive analysis of the current stock market rally. Is this bull run sustainable, or are there signs of an impending slowdown? Let's take a closer look at the key factors driving the market, including interest rates, corporate earnings, and economic signals, and discuss what might unfold in the coming months. Hey everyone, welcome to Market Visionary. I'm just starting out, and I need your support. If you're enjoying this content, please hit thumbs up, and subscribe. As a thank you, I'm offering gifts to my early supporters. Just comment, subscribe, take a screenshot, and email it to the address in the description. You might get a special reward. Thanks for being here. Let's grow Market Visionary together. Interest rates and their role in market momentum. The stock market has been on an impressive upward trajectory in recent months, largely due to the Federal Reserve's decision to lower interest rates. These cuts have made borrowing cheaper for companies, boosting their profitability and encouraging investors to pour money into stocks. When interest rates fall, it becomes more affordable for businesses to finance expansions, invest in new projects, and improve operations, which positively impacts their bottom line. This increase in profits, in turn, attracts investors, leading to rising stock prices. At the same time, lower interest rates reduce the attractiveness of bonds. Typically, when interest rates are higher, bonds provide better returns, making them a more appealing investment for those seeking lower risk. However, in the current environment of lower rates, stocks become a more attractive option as their potential for higher returns outweighs the relatively low yields offered by bonds. This shift in investment preference has funneled billions of dollars into equities, pushing major indexes like the S&P 500 to record highs. Since the rate cuts, the S&P 500 has gained significantly, and the market has responded positively to the Federal Reserve's stance. However, this raises an important question. How much further can this rally go before we see a market correction or a potential slowdown? Corporate earnings, a key driver of stock prices. A major contributor to the recent stock market rally has been better than expected corporate earnings. Earnings season, when publicly traded companies report their quarterly financial results, has been a key factor in maintaining the market's momentum. Major companies, especially in sectors like finance and technology, have reported strong earnings, surpassing analyst expectations and reinforcing the belief that the U.S. economy remains solid. For example, banks like JPMorgan Chase and Wells Fargo have posted impressive earnings, indicating that the financial sector is performing well despite broader economic concerns. This is a positive sign for the economy because banks are often considered bellwethers for economic health. Strong earnings from financial institutions suggest that businesses and consumers are borrowing, spending, and investing, which supports overall economic growth. Beyond the financial sector, other industries are also showing resilience. Companies in the healthcare and consumer goods sectors, such as Johnson & Johnson and Procter & Gamble, are expected to release solid earnings reports. These industries tend to be less sensitive to economic cycles, meaning that they can perform well even in times of uncertainty. This diversification of strong earnings across multiple sectors is a positive sign for the stock market's continued strength. However, it's important to note that not all sectors are benefiting equally. The rally has been disproportionately driven by a few mega-cap technology companies, particularly those involved in the development and deployment of artificial intelligence (AI) technologies. While these tech giants have experienced remarkable growth, many other sectors have struggled to keep up, creating a market that, while broadly strong, has some underlying imbalances. Technology and artificial intelligence leading the market's charge. The technology sector, particularly companies involved in AI, has been one of the primary drivers of the current stock market rally. AI has generated significant excitement among investors due to its potential to revolutionize industries, enhance productivity, and create new revenue streams. Companies like Google, Microsoft, and Nvidia are at the forefront of this technological revolution, and their stock prices have surged as a result. For example, Nvidia, a leading producer of microchips used in AI applications, has seen its stock price soar as demand for its products continues to grow. The recovery of the global microchip supply chain has further boosted the profitability of tech companies, which rely heavily on these components for their operations. Meanwhile, Google and Microsoft are investing heavily in AI technologies, developing new applications and services that could reshape industries ranging from healthcare to finance. While the mega-cap tech companies are leading the charge, there's hope that the broader economy will start to benefit from the continued development and integration of AI technologies. As AI becomes more widely adopted, other sectors may begin to experience growth, providing a more balanced and diversified market rally. However, for now, the market remains heavily reliant on the performance of a small group of technology companies. Interest rates. What's next for the Federal Reserve? The Federal Reserve's decision to lower interest rates was motivated by its goal of controlling inflation without triggering a recession, a delicate balance that economists often refer to as a soft landing. Achieving this soft landing is challenging because the Fed must reduce inflationary pressures while keeping economic growth intact. So far, the U.S. economy appears to be holding up well. Unemployment remains low, consumer spending is steady, and inflation has shown signs of cooling off. This has helped maintain the positive sentiment in the stock market, as investors believe the Fed's rate cuts will support continued economic expansion. However, there are risks to this outlook. Inflation, while moderating, could re-accelerate if supply chain disruptions or other external factors push prices higher. If inflation rises significantly, the Fed may be forced to reverse course and raise interest rates once again, which could dampen the stock market's rally. For now, though, the Fed's dovish stance is providing a tailwind for stocks. Geopolitical and domestic risks to watch. While the stock market's upward momentum remains strong, there are still risks that could disrupt the rally. Geopolitical tensions, particularly in the Middle East, have the potential to create market volatility. Historically, geopolitical shocks tend to cause short-term sell-offs in the stock market, but these sell-offs are often followed by a quick recovery as the market refocuses on economic fundamentals. In addition to geopolitical risks, domestic politics also pose a potential threat to the stock market. The upcoming U.S. presidential election is likely to introduce uncertainty into the market, as elections typically increase market volatility. In the months leading up to an election, investors often become more cautious, leading to fluctuations in stock prices. However, it's worth noting that in the long run, economic fundamentals tend to have a greater impact on stock prices than political events. The struggle of smaller companies. Will they catch up? While large-cap technology companies have been driving the market's gains, smaller companies have not fared as well. The Russell 2000 index, which tracks smaller U.S. companies, has struggled to keep pace with the S&P 500. Smaller companies are often more closely tied to the domestic economy, and they haven't benefited as much from the global economic growth or the AI boom that's propelled the tech giants. However, there is potential for smaller companies to catch up. If the broader economy remains resilient and interest rates stay low, investors may begin to look for opportunities in undervalued sectors that have lagged behind during this rally. This could provide a new driving force for the market and help smaller companies participate in the rally. Conclusion: a balanced approach, moving forward. As we look ahead, it's clear that the stock market's current strength is supported by a combination of factors, including solid corporate earnings, resilient economic data, and investor enthusiasm for technology, particularly AI. However, there are risks on the horizon, including potential changes in interest rates, geopolitical tensions, and domestic political uncertainty. From my perspective, the fair value of many stocks appears slightly above their current trading levels, but it's essential to remain cautious and stay informed as new data emerges. Keeping a close eye on broader market trends, while also looking for opportunities in sectors that may have been overlooked, can help navigate the potential volatility that lies ahead. Let me know your thoughts in the comments below. And don't forget to like and subscribe for more in-depth market analysis.